I think the most encouraging thing from my standpoint that I just push back a little bit on Neil is that the credit markets have improved, right? They've improved with the equity markets. They certainly took a hit as the market was going down, but they didn't deteriorate as fast as we would have expected given the deterioration in equities. So in a lot of ways, what that says is the equity market decline was a sentiment related decline, obviously on the prospects of the unknown, of policy uncertainty, everything else. But it wasn't really infecting credit yet. And so as the markets rallied, the credit markets have firmed. They've come back. Most of those spreads are back to where they were prior to quote unquote Liberation Day, and that's good news.
RenMac Off Script originated as a weekly internal research meeting designed to summarize and discuss what happened in Washington, the markets, and the economic data over the past week. It was always intended to be and remains a free-flowing conversation with no discernible objective other than to extract the wisdom and opinion of our analysts and their expertise. This is a conversation among colleagues. Individual circumstances are unique and nuanced. Do not mistake these conversations for investment advice because it's not. Here we go.
All right, welcome to RenMac Off Script, where we openly discuss markets, economics, policy, history, and life. It is Friday, May 9th, 2025. I'm Steve Duttenhofer.
I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlik.
As a reminder, all the charts we reference are posted to our Twitter account and our LinkedIn account. For those who are investing their own dollars, I encourage you to be a RenMac Access subscriber at renmacaccess.com. And for those on the institutional side of the business who aren't already clients, feel free to reach out to sales@renmac.com for more information on how we can help you navigate the market. So a little different this week. I'm here to help out as Jeff is down in Florida with his son's graduation. How to do with the intro?
It's pretty good, Steve. Well done.
All right. Maybe I got a shot at doing this next week. So let's kick it off with you, Jeff.
Let's not get over our skis. Okay, easy.
And that's a wrap, everybody. We'll see you next week. Let's start with you, Jeff. Nice work last week on the Derby, by the way. Nice picks. But you dusted off an oldie but a goodie this week with the RenMac Retest indicator. Frame it out for us, what it is, what it's telling us, what it's not telling us, and how we should be thinking about the markets here, given that indicator.
Well, let's hold on just a second here. We got two Catholics on this call. We didn't talk about the new Pope yet. So my big question was this a ploy to keep tariffs on Catholicism out of the U.S. by do you elect it? Guess you elect a Pope. How does that work? You appoint a Pope, or the good Lord appoints it. My next question is, for communion, are we now talking Chicago-style deep dish and a pitcher of Old Style instead of the wafers? And I mean, I think it's a whole upgrade. I mean, I might move from my centuries family tradition of the Bank of England, the Church of England, which is now basically Episcopalian, over back to Catholicism. I mean, it's such an upgrade for you guys.
I'll tell you what, if you're a Villanova grad, it is a heck of a week. Brunson in New York and now the Pope. It's a good one.
I definitely think the Pope did better with the 45 to 75-year-old male demographic than Donald Trump. Undeniable. I mean, he thought his margins couldn't be beat, but I think the Pope did it.
Well, from the political standpoint, because there are a lot of politics that go into any vote, I think it's worth noting that Leo XIV was Francis's person to name a lot of the new bishops that ended up deciding the vote. So they were familiar with him. So sort of stacking the deck there. I have nothing against him. I'm wishing him well as a practicing Catholic. I did see a lot of memes that said America's back, which I don't really buy into because this is the first American Pope. So how can we be back with this? But I digress.
Yeah. Anyway, Steve, go back to what we were talking about.
Back to you. The RenMac wow, nice segue. The RenMac Retest indicator. Talk to us about it. What it's telling us.
Yeah, look, that was something that I looked at back at Lehman Brothers. I mean, this is way back in the day, right? So the idea is, where do we get into this zone where we can feel comfortable that the retest scenario, what that really means is that the market goes back down to the lows that it previously had, and then rallies from there. How do we try to mitigate that or handicap whether or not that retest scenario is in play? And so, a real simple rule that we found works pretty well. It hasn't worked as well actually recently as it did back in the day. But the rule was essentially if the market's down 20%, which is, quote unquote, the definition of a bear market, at any point from 20%, whether that goes down 30%, 40%, whatever the case may be, it just kind of gets the clock ticking. So down 30%, the clock starts ticking. Then you look for a 50% retracement from that low, whatever that low is. Again, 20%, 25%, 30%, wherever that is. And you can do that in real time, right? So you have a 50% retracement. Once you do that, once you've retraced 50% of a 20% or more decline, the probabilities of a retest scenario, or actually breaking down below that, start to go down dramatically. And so that was one of the things that happened last week. Was this retest scenario played itself out, where we're unlikely to get the retest because we had the 20% plus decline. We rallied 50% off of that low, or took 50%, I shouldn't say 50% off the low, a 50% retracement of that decline. And that really starts putting things more in line with the 1998 scenarios, the 2002 scenarios, etc. The one issue that we have to think about here is 2008 that didn't work. And so for us, that's just, hey, you keep a stop below that previous level, and that'll keep bad things from happening. But kind of how we think about it is it starts to really skew things more towards the unlikely probability that we're going to undercut or retest those lows, and the more likely scenario that we probably consolidate here in the near term, and then we start to re-engage in the trend. Now, our trend work still hasn't moved positive. It's now neutral officially. We haven't had the momentum signals, but if we can start taking that retest scenario off the board, that certainly helps frame how we want to be thinking about the world over the next 3, 6, 12 months.
So stick with the beta trade as you've been calling for.
Yeah, look, I think the beta trade's overbought now, but if we look at the percentile of performance of beta, I think it's in the 3rd, maybe 4th percentile. I didn't look at the data last night, but it hasn't moved significantly. And really what you're looking for is that percentile just kind of normalized should be 50, right? There shouldn't be any advantage to beta versus non-beta historically when we look at that. And so if we're in the low single digits, it still says that beta has been unmercifully crucified. Let's use that in the Catholicism tradition. And so it should come back and have a little bit better performance there.
Right. So beta, relative leadership, breakouts, any other sort of emerging themes?
Well, I mean, that's a good point. So you historically want to be looking for relative strength leadership at this point, right? The transition is momentum, beta off the bottom. And then what you're really looking for is what's sustainable. And so for us, we're looking for relative strength new highs. We're looking for those names. One tidbit I just throw out there is that the software security stuff looks pretty good, right? The guys that keep us from getting overly hacked. Those names look pretty interesting as they're making new relative strength highs. And there's some other cats and dogs in there that are pretty interesting too, MasterCard, etc. But that's kind of how we're thinking about it. Is let's find the new relative strength highs.
Gotcha.
Hey, Jeff, I actually have a question for you. We hear a lot about a lot of this trade uncertainty is causing companies not to make investment decisions. I guess, what is it too early to know what they are doing with their cash? And I guess, what are their options?
Well, those are usually board decisions, right? So that's not just the wave of the wand that goes to the board and they say, hey, we've got, we're going to reallocate dollars, reinvest in the business. We're going to pay a dividend, or we're going to buy back stocks, we're going to pay down debt. Those are all capital allocation decisions. Those come at the board level, and they tend to be long-term decisions. You don't go do it quarter by quarter. You kind of say, hey, here's our trajectory, and the best return for the company is to buy back stock, and maybe we can issue debt at 3% and buy back our stock, and that'll be a net benefit of like 10% to the company or shareholders. It's too early to know what that is, but certainly if you're not going to buy back stock, the stock buyback, there's some evidence. There's actually some very good evidence that stock buybacks are proportional to interest rates and corporate spreads, right? In other words, if I can issue debt relatively cheaply, then why not use that cheap funding to then go buy back more expensive funding?
Speaking of boards, Neil, Fed had a meeting this week. Any takeaways?
Not really. They didn't do anything. Look, I think what I find really I understand what they're doing, but I just say that, using uncertainty as a crutch to avoid making a determination about things is really, in my opinion, just sort of like your job is to make decisions with imperfect information. Sorry, like that's what you signed up for. So, I think that they're conditioning themselves to be behind the curve. And I think it's kind of interesting that Powell says, well, there isn't a big cost to what we're doing. We can wait. And I think there is a cost, honestly. So the cost is, he says, policy is well positioned. The cost of waiting to see further are fairly low. Well, there is a cost. The cost is unemployment, right? Like life is about trade-offs, and that means weighing benefits and costs. And right now, the Fed is basically telling you that they're more concerned about inflation, and that's a function of what's going on with tariffs, and that's why they're waiting. I think that's probably going to be a mistake, because even in the press conference, Powell himself couldn't really explain why the tariff shock would be anything more than a one-off. So, we're kind of back to the same. I mean, to me, the biggest gap between myself and the Fed is really just around the current state of the economy. I mean, I think they're characterizing things as solid. The labor markets are solid. Growth is solid. They kind of paid lip service to Q1. I mean, they said, well, it was all just a function of like swings in exports and imports and stuff. I mean, imports, excuse me. Tariff front running, and they talk about how private demand is good. But look, I mean, consumer spending posted its weakest quarter in well over a year. So it's not just tariff-related noise. So I think there's a bit of willful ignorance here around what the economy actually looks like. And that's not to say what Trump has done has been helpful with respect to tariffs. I mean, certainly the way he's gone about it has made it very painful for businesses, I think. But I think what's more important is even if you remove all of that, you're still back to this sort of square one, which is the Fed is, I think, misreading the current state of the economy.
Especially on the employment front. You had a report out this week that sort of went through some of the tells in the labor market, which seem a lot worse for you than, or at least your reading of it, than the Fed.
Well, you have cyclical areas of the labor market continuing to slow down. So things like manufacturing and construction. It's pretty rare to see residential construction employment falling, but that's where we are. And with unsold new housing inventory continuing to go up, you can only expect that to continue. Manufacturing, ironically, this trade skirmishes and war, I mean, basically started because we're trying to protect domestic manufacturing. Yet it's domestic manufacturing that appears to be, ironically, suffering as a result of this, because a lot of the domestic manufacturers source inputs from overseas. And that's going to weigh on employment. And if they're not raising prices yet, that just means that they're dealing with a margin squeeze, and ultimately they have to pay the piper somehow. So that could come out of employment later. But manufacturing employment is basically moving sideways. You look at things like ISM, it tells you that manufacturing employment probably goes down. And mining is the last one, right? I mean, in terms of goods producing, I've long suspected that Trump doesn't really care about how oil prices go down. He just cares that he's in office when they go down. And which is fine. I mean, I think that's totally fair. I mean, it is what it is. But it's pretty clear that, I mean, the oil prices are coming down primarily because markets are kind of pricing in a positive supply shock coming from the Saudis, right? As they're trying to discipline members in OPEC plus, right? Again, I mean, that is going to make it more challenging for our producers, because for most of them, the break even is, north of $60 a barrel. So if prices are running barely at that level, doesn't make any sense for them to profitably drill new wells. And that means that CapEx is going to go down. So there's a growth shock to that. And remember, oil, it's one of these things that it tends to hit investment quickly. The effects on consumption tend to be longer, right? I mean, so people need to see a sustained decline in prices before they start spending more of that savings. By contrast, businesses kind of react fairly quickly. So the investment shock will be upfront, and it's just another reason to be cautious on the second quarter.
You had a nice back and forth this week with your piece about that. I think it was a Wednesday. The SPR, that was what sort of came up as a sort of buffer or a other side of the issue. Steve, you got any thoughts on that?
Well, sure. I mean, the Strategic Petroleum Reserve, if you're talking about refilling it, that's going to require money, and Congress has the power of the purse. And so I think that's where the reason for skepticism is. Look, the optics right now, Republicans, we can talk about this as well, are struggling to come up for pay-fors for their reconciliation package. It's going to try to offset some of the cost of their planned tax cuts. So just the optics of doing that right now are difficult. I believe the Department of Energy budget request that was submitted included additional funding to replenish the SPR. The problem with that is that's going to take a long time. And we're probably looking at a continuing resolution. So you just don't have the funds available to really take advantage of these low oil prices at the moment. And, we talk all the time about Congress, take the over on time and the under on results. I think that's just sort of, unfortunately, another example of that.
But hey, we got great news on the trade front, right? We've got a deal with the UK. We've got Trump saying this morning that 80% is the right number for China ahead of the meeting. Where do we go now?
Well, I'm hoping that markets go nowhere but up. We'll see if that's correct. The devil will be in the details for everything. And I think I would apply that to the UK announcement. I would actually frame it more as an announcement as opposed to a deal. I think it's encouraging that a lot of the broad parameters were identified. It's going to take many months, perhaps a year or so, for lawyers to quote unquote paper this agreement. But it's encouraging. It has some momentum heading into these conversations with China that you alluded to. I think it also provides sort of a framework for other countries as they sort of think about, how they can approach the Trump administration to potentially find similar off ramps. So again, I think that's encouraging. That said, given the relatively balanced trading relationship we have with the UK, given that a lot of these conversations actually began during the first Trump administration, this was sort of the low-hanging fruit in terms of trade deals available. But look, getting agreements better than not. I view that as positive. I do think more of the positive upswing we saw in the market was probably related to Trump's, comments Thursday about, China in those negotiations, suggesting that he was open to reducing tariffs. And obviously, as you mentioned, we're recording this Friday morning ahead of the discussions over the weekend, and Trump sort of giving Treasury Secretary Bessent cover to reduce tariffs from 145% to 80%. Now, I think the assumption is that China will make a similar reduction as well in terms of trying to manage expectations and how to think about what to look for to view these conversations as a success. They're not going to resolve most of the trade issues. I think that's just unrealistic. I think the goal, as Secretary Bessent has said repeatedly, is to try to de-escalate things with the reduction of tariffs. I think this is a good sign. And then also sort of create the parameters for future conversations to address some of these outstanding, trade issues. Although at the end of the day, look, it's because even though we have different forms of government, we have similar issues in that, in China, ultimately, it's going to be Xi Jinping that's going to have to sign off on any deal. In the US, it's very clear that, Trump is very involved, is going to have to sign off on any deal. So I think at some point, we're going to have to look for an opportunity where both, Trump and Xi will be in the same place at the same time, since I don't think either is really likely to travel to the other side's respective, country to maybe resolve some of the issues that we can't do. But again, talking's better than not talking. If this creates the conditions to reduce these barriers, I think that's going to be received positively.
What about Congress? What about Congress? Congress approved NAFTA. Congress approved USMCA. What I do find interesting about this is one of Trump's big gripes is how Biden didn't enforce the phase one China deal. And now what it seems to me like he's going in and negotiating 100 phase one deals. He also, with Kristen Welker over the weekend, he basically said that he's not running for a third term. Okay, so good, thank you. But which sort of begs the question: if someone succeeds him, what makes these deals have any teeth in reality? Like that. I mean, so what I find interesting is, I mean, there's like the net effect of the UK deal is, I mean, it's inconsequential, right? I think it takes the effective tariff rate down by maybe 1/10 of a percentage point. So it's, you've gone from like whatever, 25.1 to 25. I have no idea, but I don't really think it matters. And I think to me, it's really about what's happening, right? And Scott Besson talked about how Wall Street craves instant gratification. And I think there's a lot of truth to that, because what you saw in April was basically the data collapse after Liberation Day, right? And then you haven't seen the hard data confirm that. Now, tariffs don't represent a sudden stop type of economic dynamic, right? It's not like the financial crisis where there's, credit is drying up. We all remember back then about how Hank Paulson worried about, commercial paper markets seizing, and maybe grocery stores won't have the credit to actually stock the shelves, right? So that was a sudden stop risk. Obviously, COVID was a sudden stop risk. This is more of a slow boil and then a roll. You know what I mean? And so, I think it's really about the sequencing. And I just say that tariffs will increase costs if companies don't raise prices in April. And it doesn't look like that's really happening in any widespread sort of way. It just means that margins are being squeezed. And then the question is, how do they deal with the margin squeeze? They either raise prices later, cut employment, cut investment. And so it's a sequence of events, not sudden stop. And so I just wonder if, the enthusiasm the enthusiasm the markets are showing you is basically, it's not so much enthusiasm. To me, it seems like, well, I've been kicking myself in the nuts for the last 2 weeks. I've decided to stop doing so. So let's go back to where we were.
Well, a few things to unpack there, I think. One, with respect to the congressional role, if you go back to the way the Trump administration approached trade the first time, there were these similar phase one agreements. Basically, the idea is let's do what we can do sort of without Congress, with the idea that they were going to eventually come back to Congress to try to make these things durable. Obviously, between COVID and not being elected for a second term sort of threw a wrench into those plans. So, obviously Trump is serving only one term now. Maybe if you have a Republican president who succeeds him, that would potentially see the congressional ratification of these things. You also mentioned the durability of tariffs. So I think one of the things that jumped out at me from the UK deal was the idea that this 10% universal baseline tariff was still going to apply, but that the Trump administration did reduce some of those sectoral tariffs that had been at 25%. Now, I always thought that those were going to be tariffs on industries that they were looking to bolster and keep them into place. And maybe that, again, is going to be the template moving forward. I think there's a question of, is this 10% universal baseline tariff going to remain throughout the remainder of Trump's term?
But that's under emergency authority, right? I mean, he's basically using an emergency, right? Like, so if they write it into the tax bill, then it makes more sense.
It does. But I think the problem there, I'm not sure they can actually write that in. I don't know that they have the votes. I think if they did, they probably would have done that, because that would have helped them on their scoring standpoint.
Sure.
To actually score that revenue. So I think it's just sort of the math problem, not in terms of identifying pay for. The math is, do you have enough votes to actually pass it? I think that's the problem. But
I would love someone in the administration to just say, you know what, Mr. President, you're right. The VAT is a trade barrier. Maybe we should do one too.
One question I had for you, and maybe for Jeff, that I think you were sort of hinting at, is at this point, is the market, now that I believe, recovered all the losses that we had after April 9th, are they sort of, again, priced per perfection, assuming that most of these trade deals are going to be, I don't know, necessarily resolved, but at least the reciprocal tariff rates aren't going to come into effect July 9th, that we're going to see de-escalation?
I mean, I think, for me, I think what's interesting about what Jeff is saying is that he's saying that, the worst is probably behind us for the market. And I would just say maybe the worst is, the market hasn't yet faced the cracking of the economy story in any significant way. And so to me, that's really the issue. So while the worst may be behind us for the market, I think there's a chance that the worst is still in front of us for the economy.
And Jeff,
yeah,
just sorry, Jeff, we've been sentiment around that because, as you said a couple of weeks ago, you got to think about what can go right, not what can go wrong. But sentiment really hasn't moved, right?
Yeah, I mean, look, that was the right call, right? I mean, look what has gone right, and now the question is, have we brought people back into the market fully? And I don't think that's the case yet. So sentiment isn't there yet. Look, to Neil's point and to Steve's point, I mean, these are the differences between the way markets react and the way the economics plays out, right? And this might end up being some huge top formation where that was the initial crack in April. We go back up, these tariffs come into place, we get the slowdown, the unemployment, all the stuff that goes with it, and we roll things over, the earnings consequences and the like, and that happens out the next 3-6 months. That's not my call, but that's kind of how tops do in fact develop. I think the most encouraging thing from my standpoint that I just push back a little bit on Neil is that the credit markets have improved, right? They've improved with the equity markets. They certainly took a hit as the market was going down, but they didn't deteriorate as fast as we would have expected given the deterioration in equities. So in a lot of ways, what that says is the equity market decline was a sentiment-related decline, obviously on the prospects of the unknown, of policy uncertainty, everything else, but it wasn't really infecting credit yet. And so as the markets rallied, the credit markets have firmed. They've come back. Most of those spreads are back to where they were prior to "quote unquote" Liberation Day, and that's good news. Now, if the economy starts to deteriorate from here, you're going to start to see those credit spreads first stabilize, and then they'll start to move higher as the prospects of aggregate demand goes down. So, I think that's something that we have to keep an eye on. I'm encouraged right here that that's not happening, but that's certainly worth noting as we go forward.
All right, let's open up the mailbag and bring in Harry Chen, the resident RenMac mailman, amongst many other things that he does. Harry?
Okay. Today we have the question from Ryan Heidenrich. And the question is, concerning the saying, the market is not the economy, certainly still holds true, but do you feel they are more or less correlated this year versus, say, the last 10 years? Thank you.
Okay. So
take that.
Ryan, concerning the saying, the market is not the economy, certainly still holds true, but do you feel they are more or less correlated? Which was interesting because the way Harry said it, it sounded like it was correlated, which actually is kind of the same thing, right? More or less correlated this year versus, say, the last 5 years. Neil, you want that, or you want me to take that?
Well, I would just say that the stock market's not the economy, but to quote my friend Joe Weisenthal, it's not the economy either, right? So that's all you could really say. I mean, I think when the economy is growing, stocks tend to go up, and when the economy is contracting, stocks tend to go down. So, right? I mean, if you're like a long-term investor, really the main call you have to make if you're just holding a broad basket of equities is like, do you think we're going to be in a recession in 12 months or not? So obviously, it matters, right? So, but the sort of month-to-month swings and things like that, maybe that's not as important. But so I would just say that I think stocks aren't exactly the economy, but they're pretty close, and they're an important signaling mechanism for households.
Yeah. Well, first I would say, Ryan, there's no evidence that the correlation is any more or any less than it's been historically. We look at that. Keep in mind that the correlation also, when we're talking about the economy, we're talking about what Neil refers to as hard data. When we're talking about the market, you're really talking about the expectations of where that data is going to be, right? So the market is usually leading the economy. That's why what I do is different from what Neil does, and both obviously have value in the marketplace. I think the way that I would frame it, if I was going to try to explain this to my mother, would be the economy and the markets relate themselves to trends, and those trends tend to be highly correlated. Now, I would say those trends are even more highly correlated if you look at the market and let the market lead by 6 months, right? So the market trend is going to lead by about 6, maybe 3 to 6 months, what the economic hard data is going to do. If you look at the rate of change, or you look at the sort of volatility, because there is emotion to it, there's a lot of other inputs that may or may not affect the economy directly or indirectly, are going to be reflected in the market. And that's things like what we're just talking about, right? So tariffs, the prospects of tariffs, the prospect of trade negotiations and thaws, all those things get priced in where they don't hit the real economy and the hard data, because obviously that takes time for people to make layoff decisions, to make investment decisions, all those things that we discussed. So my world is going to be far more volatile than Neil's world, and that's just the nature of the beast.
That's great. And Ryan, you'll get a nice shiny new RenMac trucker hat delivered to you. So thanks for the question. All right, lightning round around the horn. Neil, what are you watching this week?
Wait, this is a new segment? We got some new segment coming up? All right,
Yeah,
here we go.
It's I just threw that one in there.
What I'm watching.
What are you watching?
Yeah. So, speaking of market comebacks, I mean, how about the Knicks? Okay, I mean, that's what I'll be watching this week. That's gonna show up in inflation in the May data, because the apparently getting into Game 3 at the Garden is like the most expensive ticket for a playoff basketball game ever. So
what's a Knickerbocker, by the way? What is a Knickerbocker?
I think it's a Revolutionary War thing, if I'm not mistaken. Or I don't know, whatever. Who cares?
It hasn't been canceled yet, though. Is there the prospect that a Knickerbocker could be canceled?
Hold on. What is a Knickerbocker? I'm gonna let you know.
Style of pants.
I said pants.
Yeah.
And a term associated with New York. How about that?
The word Knickerbocker signify a New Yorker who could trace his or her ancestry to the original Dutch settlers. So
there you go.
Jeff, there you are.
Yeah. Our resident Knickerbocker.
So at any rate, next week the main data point is going to be CPI inflation. We also get data on retail sales. So sort of a number of important indicators. Also, industrial production. Keep an eye on manufacturing production. We saw a big decline in manufacturing hours worked last month in April, and so that should bleed into manufacturing production. So lots going on, but inflation, retail sales, and manufacturing production are what we will be keeping an eye on.
And Steve, what's on your agenda this week?
Well, a few things. One, continue to watch for the trade headlines, obviously. I think House Republicans are going to try to move forward with more contentious committee markups that, quite frankly, the issues they weren't able to resolve this past week. They're trying to do that on Tuesday. We'll see if they're successful. Speaker Johnson still trying to get the House to pass their version of reconciliation prior to the Memorial Day recess that's supposed to start, I believe, the week after next. That said, I wouldn't get too wedded to what you see here, because I think the Senate is much more comfortable with the deficit finance approach. So I think what the Senate will likely do is probably adjust whatever the House, assuming they're able to pass something, the dials that they have on the tax, namely the time, increase some of these things to make them permanent, which again cost more if you're going to do that. The other, I guess, tool that you have there with respect to the dials is also income thresholds, qualifies for certain breaks. And then my guess is it'll probably be less generous, they being the Senate, on the spending side. So that's something to watch, I think, beyond next week. But again, the House will maybe set this initial baseline to work off of. And then I am going to watch President Trump's trip to the Middle East. This is going to be technically his second foreign trip, because he did travel to Italy for Pope Francis's funeral. But the fact this was the first planned trip, I think, just shows the great emphasis that the Trump administration is placing on the Middle East. I think tying it into sort of the trade discussions, probably looking for increased foreign direct investment. So I'd be surprised if you don't see a lot of announcements there. Could see some maybe trade deals potentially, or something related to that. I think we talked about oil and OPEC. Clearly, that's a focus of this administration, trying to reduce energy costs. Be surprised if that's not part of these discussions. And then, I think from the Trump administration's perspective, Saudi Arabia is a good diplomatic tool to use to try to get to Russia, given their sort of relationship there with OPEC plus. So Trump's trying to resolve the situation with Ukraine, and also you have tensions there with Iran and Israel. So I think it'll be a pretty busy trip.
Jeff, final thoughts?
Hey, who's the Interior Secretary? Bergram?
Doug Burgum. He
Yeah.
was the one-legged governor because he broke his foot at the time, if you recall, from the 2024 presidential debates on the Republican side. Fracker.
Okay, I must have missed that one. The Knickerbockers must have been playing that night. Anyway, I'm just saying this because there was a podcast with him and David Freeberg who does some of the all-in stuff. It's great. I think it's like 30 minutes, but it really, I thought it was really an interesting insight into kind of the resources in the U.S. And anyway, if you get a chance, listen to it. Not at the expense of this podcast, obviously, but if you get a chance, you should listen to it. Steve, I'm watching 5,700. I mean, that's the resistance level. I think it's 5687. I think officially it's a 200-day moving average. So that's sloping downward. That's kind of natural resistance. We have a lot of really tactical overbought indications, so I think we can consolidate and kind of churn here. I'm not here to fade Donald Trump and his tweets, but go buy stocks because we're dealing with China. It's like, okay, that's amazing. So I think I'll fade that a little bit, at least in the near term. Look, the big things that we're looking for is confirmation that trends are improving and momentum has in fact developed into escape velocity. We haven't seen that yet. All we're willing to do is say there's a very high probability, and I would put that probability in that 90% camp, that the lows are in. In other words, we will go on to make a new high before we make a new low. I think that's fair given the retest rule, the RenMac retest rule that we have. But we haven't yet seen, again, that change in trend. We haven't seen that momentum. So we're going to be looking internally for things like that. Good news, Bitcoin's back over 100,000. So that's a good indication for risk assets. When we break things down and look at the relationships of sectors, what sectors are doing well versus bad, and we have a lot of different relative relationships that we look at there. Banks are outperforming utilities, even though utilities look good. Discretionary, believe it or not, is actually still outperforming staples. So all these kind of more risk-on indications are there. And I think that's good news. I'd like to see bond yields not only stabilize, but move down. If we can get that through 413, I think that's good news. I don't want to see it, much lower than say 360 on the downside. Oil, obviously, weaker is good news. I think gold is vulnerable here to a correction, but all things considered, I think we're going to consolidate in the equity markets, kind of gain our footing, and people will start to gain confidence, and I think push us higher.
All right. Thanks, guys. I think that's a wrap. I appreciate you letting me join in this week.
Wait. So how are we gonna rank this? This is kind of like the what is it? America's Got Talent. So Neil, you can be Simon Cowell. You're kind of the curmudgeon-y prick on the podcast. Go ahead. Where do you put him? I'm giving him a B, just for reference. I think Steve did a masterful job, and half of that grade is diminished because of his alma mater.
Go Blue.
I think you did a great job. I mean, I prefer this format actually going forward.
Wow. All right.
Wow. I didn't get the golden buzzer though.
If Neil was Simon, am I Randy Jackson? I guess.
You're Heidi Klum.
You're Paul Abdul.
I've heard that before. I'll give him a B+ because of the Connor Stallions thing. I just sort of keeping him from the A range.
Just will never leave, will it? Just will never leave. Well, anyway, thanks again, guys. Hopefully you'll join us next week when we'll be 1 week older, 1 week wiser. And don't forget to follow us on Twitter and YouTube, where you can subscribe to that channel as well. Until then, I'm Steve Duttonoffer.
Peace out, guys. Thanks, man. Good job, Steve.
Bye.